Live from our studios in Tucson, Arizona. For the millions of fans listening around the world. From Long Realty with John Smith and Matt Bollinger. Let's get ready to talk real estate. Welcome to Real Estate Rumble. My name is John Smith. I'm here with my partner, Matt Bollinger, and our special guest from Prosperity Mortgage, Ryan Fitzgerald. Introduce yourselves, guys. Ryan, Matt, say hello.
Matt Bollinger here.
Hi, I'm Ryan Fitzgerald from Prosperity Home Mortgage. Good to see you.
Yeah, good to see you. Thanks for joining us. And hey, here's kind of what's been going on my mind. It's interest rates, okay? And how can people afford to purchase a new house or a resale on a house? And how much does the decisions that they make now affect them long term? In other words, are the interest rates going to go down? Is somebody going to step in and say, "Hey, we need to make an adjustment for the public"? You know, what's going to go on? Because to me, like I was saying to you earlier before the start of the show, I think this is all a hangover from COVID. I think COVID and the people that set the interest rates at that time did us a disservice. Okay, and you don't have to agree, Matt. I see you over there shaking your head. But I think they did a service. You can't drop interest rates down to 2 and not have a long-term effect, especially on people's mindset.
I agree with that. Okay? I think now we've got people stuck in houses that maybe they don't want, but they've got a payment that's significantly lower than what they'd be moving towards. And I think that does. I don't know that I would necessarily call it a COVID hangover, but it's definitely,
there's symptoms to every problem.
An interest rate hangover.
Yeah, and I think interest rates needed to go where they went during COVID, but it's not necessarily a disservice. It just was where the market was at that time. Now we have them bump back up, and the problem is, just the recency bias of saying, 3.5% compared to 7% today. That's astronomical. When I could show you charts that say 7%. In the history of mortgage interest rates, is actually below average.
But people were losing their minds, okay, and throwing a large amount of money because they could get a low interest rate. And as we talked earlier, we used the example of 100,000 over, but probably reality, the biggest one I saw was about 65,000 over. Mm-hmm. But that's still an enormous amount of money to overpay. At what point does it not make sense?
Well, I think one thing that most buyers look at is what makes sense for them on a monthly basis, monthly payment.
Correct.
I think the relationship of paying over asking for a home wasn't really based on because the interest rate's 3%, 2.75. It was just what they needed to do at that time to get a home.
So do you think people are shopping payments like in the car lot industry? I mean, hell, you can finance a car out to 84 months just to get the payment they're looking for, but they're not realizing the impact that's going to have on them financially over the term of the loan.
I think everything that people do nowadays seems like it's based on your monthly payment, what you can afford on a monthly payment. I think we have a generation of home buyers now that know nothing other than sub-4 interest rates.
Right.
And that has created its own issue. Older buyers who've been through the 7, 8, 9% interest rates, 7% that it is now doesn't seem like it's so crazy, but there's a whole probably decade of buyers that know nothing other than sub 4% mortgages.
Yeah, I agree with that. I think we're getting to a new normal. We were talking, we've been waiting. Matt, you generously said since maybe January. I would say maybe a year before that even.
Agreed.
We've been waiting for the rates to start dropping again. We've been predicting in my business. I stopped using the glass ball and making predictions, but we've been predicting that the rates would be going down, and we haven't seen it to any reasonable stretch. So I think more people are getting accustomed to where they are today. So let's say 7% on a 30-year conventional today. I think people are getting more accustomed to that, and we're seeing more buyers become acceptable to them.
Yeah.
But I agree with you. There's a lot of people just recency bias perspective, whatever, that 4% or less is what they expect or what they want to make that move, and it's hard to get them to make a change without that.
I know you can't predict the future, but do you ever foresee it going below 4 ever again?
I don't see it anytime soon. I think our new normal I just said I stopped looking in the glass balls, but
Right.
I would say our new normal probably, I'd love it to have a 5 in front of it, but it could have a 6 in front of it. And I think rates will go down. We were talking earlier about the Fed adjustments, and rates I think will go down, hopefully a little bit by the end of the year, but I don't think we're going to see any big drop. I think, to see 4 in front of the number again, it would probably take either a great deal of time
in the economy.
Either a great deal of time or a major market, event, something like a pandemic.
What I don't understand is, I thought, my opinion, and I'm not a lender, and nor do I pretend to be one, just because I stayed at a Holiday Inn Express. Exactly. But what I thought is that we would see some change around the election.
Yes.
And that the election would help push rates down a little bit.
I think we're going to see that still. The rate expectation, or at least, is that they will come down some by the end of the year.
We said that 2 years ago?
Yeah.
Well, we have been saying, to your point, John, the election year, it matched up with what the Fed was saying. The Fed started the year saying we're going to cut the Fed overnight funding rate, and big point to everybody, it's not the same as mortgage rates, right. But mortgage rates move, kind of in mirror to that, that they were going to cut their rate 3 times by 1/4 of a point, probably each time, was the projection. We're down to 1 time and 1/4 of a point. But, we still have roughly half the year to go. The election's still 4 months away. So I think there is still time to see some lowering of the rate. I just don't think it'll be anywhere on the scale that we were hoping for it to be. Well, I mean, I was marching around, I'll admit it, I was marching around 2020, beginning of 23, saying we were going to end 23 at 5.5.
That was your prediction.
That was my prediction back then,
yeah.
And obviously we didn't. We didn't end any lower in 2023. But I still think we'll see some lowering, but it just won't be. It won't be that monumental.
Employment's still strong. Some of the key factors that they look at are still strong.
Yeah, they still like the numbers they're seeing, and they're not seeing any need to make the change based on the numbers they're seeing. So that's why.
Well, what about the reduction of home purchases? What about that? The lack there of inventory. Does that not?
Inventory's come back a little bit, but not anywhere near a normalized market, I think. But new home builders typically take a lot of the slack out of the market. They're building as fast as they can.
There's people building subdivisions just to rent them out.
Oh yeah, there's a huge one right next to my house, northwest side.
Yeah.
They're building, I think it's 400 plus homes, brand new, just as rentals.
So I want to go back to talking a little bit about interest rates and what drives them up and down, because we talk a lot around here and we just discuss things. And I've heard discussions about, in order for interest rates to come down, people have to lose their jobs. And the job market has to kind of bottom out a little bit to make it drastic.
Typically that's what, not in terms of just mortgage rates, but like
interest rates in general.
If they see weakness in the labor market, they're gonna adjust those things going forward. So, but the investors in the lending side of it, they're already looking out.
Yeah.
3 months, 6 months, trying to make their predictions as to where things are going to be. And so a lot of times by the time we get there, correct me if I'm wrong, Ryan, but a lot of times by the time we get there, it's all the adjustment in that market has already happened. I mean, it's just kind of part of the.
No, that's a very important thing to remember is mortgage interest rates are projecting the future. They're, we're closing on loans. The end investor's not getting it for 3 months. So we have to be out in front of it. So the Fed moves are highly predictable,
Right.
And so we're already putting that into the interest rates. We're already expecting it. It's only when things come out differently. Last summer, the consumer price index, I think it was in the month of June, went the wrong way than it was projected to go.
Right.
And it was a spike in interest rates because of that. And it was
And you can see what the tolerance level is in the market on mortgage applications. If you look at those,
it happened.
It goes quick.
Okay.
Yeah, and it happened, but in 2 weeks it was back.
Yeah.
Because it's a short spike because of an unpredicted
And
event.
then another thing comes out
Yeah.
on another gauge that they use.
There's so many reports. I mean, there's on a monthly basis, there's probably 20 reports that come out on financial numbers that affect what the Fed's planning on doing. And
the Feds, you say the Feds, is this some wizard behind a curtain that actually has a formula, or are they just pulling chicken bones out of a hat and trying to predict the future?
No, the Federal Reserve is a very
influential,
very knowledgeable group that determines the Fed overnight funding rate for short-term overnight loans,
like bank to bank
transactions. And then what that is that's kind of the basis for everything. And everybody looks to that to determine what they're going to do with their rates. They take in so many factors, and they're meeting 8 times a year. Pretty much every month, except for they take a couple gaps, obviously, and they're just constantly looking at things like the consumer price index, the jobs numbers, and things like that
Producer
to see
price index,
to see what the overall economy is doing and seeing how they can.
Are they
help.
independent from the lending industry, or are they the lending industry that's actually driving this? Are they independent?
Not the mortgage. They are independent from the mortgage lending industry, but they can have an effect on it. They can make things. What they were doing during COVID was they were buying or telling the federal government to buy mortgage-backed securities. And so when they were buying up the mortgage-backed securities, that helped the interest rate. They
helps clear the pipeline.
Helps fund all the loans. And they completely backed off that and stopped that because they had bought so much. And now they helped the market adjust, and now they needed to let it do its own work.
Well, let's go back to 9/11, just because I don't have a memory on it, right? That was a pretty big, impactful thing that hit America. And pretty much our economy shut down. What happened to interest rates then? Does anybody remember? Did that cause interest rates to go through the roof?
No.
Before my time.
So why not? Now, I'm trying to be a pain here, but I'm trying to see the correlation between a natural disaster and...
Because when those things happen, typically, when large things happen in the economy, and what happens in the United States typically affects everywhere.
The world, yeah.
Typically, they will lower rates to get economic activity started again, not the other way around.
I get it. So we needed our economy to be boosted. So in order to do that, we needed to loan money.
Which is exactly what happened during the COVID.
And we lowered it. Okay, so now I'm understanding a little bit more. Okay,
yeah,
and that was the purpose of lowering the interest rates, so we could get people to initiate the market again or interact with the market.
Yeah.
It's activity. And
so now we don't care. I mean, we raised interest rates. So, I mean, don't we still need that? Don't we still need the industry to be strong in order for our economy? Because the world kind of looks upon us that. Don't we still need interest rates to be at a usable amount?
I think that's an interpretation of, opinion on what's a reasonable interest rate. But I think, you need reasonable interest rates for the economy. If they're too high, it's going to slow stuff down. If they're too low, it's going to light a fire.
And I think what they're trying to do is find the right spot without doing it on a drastic level.
Right.
The pandemic caused for drastic measures, buying up mortgage-backed securities at a ridiculous rate. Helping to lower the Fed overnight funding rate to basically zero, and all that drove interest rates down on everything, not just mortgages, but on everything, which spurred the economy, which is what you're talking about. And now we don't want to go drastically either way. Obviously, rates have shot up a bunch, but to Matt's point, what is a normal rate is kind of an opinion. Can be an opinion, like I mentioned earlier. We're still below the historical average on mortgage rates. So we need a drastic measure. There's not a lot of supply out there. I often talk, and you guys have heard me say, if I wave the magical wand and make interest rates 5.5% today, what would happen?
Somebody bitch that it's not 4.
But I think
maybe, but I think we'd all agree that we would see a huge influx of mortgage applications and buyers coming out of the
But
woodwork.
then prices are going to go up.
Exactly.
And then people got to offer over ask again. Now
That's-
we're offering
that's the
15,
inflationary
20,000.
side. The not only companies but now individuals are leveraged, and the economy is basically built on leverage, which so borrowing money. Well, if you could borrow money at really, really low interest rates, it's going to spur economic activity. So now that things are a little higher, it's supposed to slow it down. So far, it hasn't seemed to do that. And so we're still seeing the inflationary and the compounding inflation that people don't talk about. I mean, that's like, well, the tires I recently bought, the last time I bought them, they were $1,200. Now they're $1,500.
Right.
Or the windows that I just put in my house were, 30% lower a year ago.
Do you think that's greed? I hear a lot of barking. Let's use a big Golden Arches restaurant that we all know and love, right? Some of us. But even their prices have gone up.
Everything has
gone up. I could go sit down and have a meal before I go to a drive-through.
Yeah.
And pay the same.
That too.
Yeah. I think that there's the effects of an inflationary environment are a lot longer than what people expect them to be. I think that what happens is prices go up, they get sticky where they are. Have your property taxes come down? There's an example of even if the house value goes down, typically your property taxes don't race down to the same number. So same thing happens with goods and services. I think once they're up there, the grocery store is a perfect example.
Right.
What you could put in a cart and how much it cost 3 years ago versus now is significantly different. It's way higher now.
But isn't that a natural progression, Matt? Isn't that, prices are going to eventually go up.
Not at the
they're never going to go down. Does anybody predict the groceries are going to go down? I wouldn't. If I'm going to sell an apple for $10, next year it's going to be 11. I'm going to try.
Yeah, that's the thing that's affecting people's ability to not only buy regular everyday stuff, but buy real estate. It eventually, there's a tipping point. I think we're not necessarily there, but there's a tipping point in what people can afford. That's why what we were talking about before, everything is, your family budget is based off of monthly payments that you can make and what you can afford, et cetera, et cetera. I think that, you could, I think what people miss on regular goods and services inflation is the compounding effect that it has. And that's why I don't see prices on those things coming down. Maybe a little bit on some things, but I think it's going to be kind of our new normal.
There used to be a $1 menu, now it's a $5 menu.
But people are making more money too. It's just not keeping pace with the.
That was my next question.
Well, part of the price is because people are making more money.
Exactly.
Well, that's where it's going. Do you think the increase in minimum wage, at least in Arizona, drove up prices? That's probably what drove up the fast food restaurant, right?
I think that's the biggest thing. Yeah.
Yeah, and the fast food
cost
for
of
sure.
Goods, it's that too, but I think the biggest one is probably labor. That's why they're going to all be robots.
Right.
So
that's why you have to help yourself. That's why you got to do the work.
But the
at a lot of
prices
places.
didn't come down.
Well, but
there's industry costs with the robots.
Everything, yeah.
Or they're not also going to pass all the savings along to you either.
Oh, you mean profit?
Opportunity.
Not profit. It's opportunity. Okay.
No, I think that I don't see a lot of those things coming down anytime soon.
Okay. Hey, let's take a quick break real quick, and then we'll come back and talk a little bit more with Ryan Fitzgerald from Prosperity Mortgage. If you have any questions about today's show, feel free to reach out to us directly at Smith & Bollinger at longrealty.com. And always remember, we're here for you for all your real estate needs. Whether it's residential, commercial, investment, or land, we got you covered. Hey, welcome back. This is John and Matt with Real Estate Rumble with our special guest, Ryan Fitzgerald from Prosperity Mortgage. We're talking interest rates. We're talking the bloodbath of the mortgage and lending industry.
Bloodbath. Jeez.
We don't use that word.
We don't use that word? I used it.
The wonderful lending that we do here at Prosperity Home Mortgage.
I'm not saying I'm talking the industry in general.
No, I know you are.
Okay, and by the way, I've used Ryan. He is a fantastic lender. I would recommend him any day.
I agree 100%.
So let's kind of get back to it. We were talking about, rates, whether they're going to come up, come down, when can we expect it? Is there a magic wizard that fix all this? But basically our biggest concern really is the potential future buyer. So we love to work with first-time home buyers just because, I get an opportunity to educate. It's our goal to make sure they walk out with the most educated experience that they've ever have. And we trust a lender that does so. But my question to you is, how many first-time home buyers are you seeing put in applications right now?
A good deal. I'd probably say 25 to 30% of my business get first-time home buyers.
In pre-COVID, Can you give me that number? Was it a bigger thing pre-COVID?
No, I wouldn't say pre-COVID it was a larger number.
Okay.
I would say probably in general it's been about that. You guys and I, we had a first-time home buyer last month.
Yep.
A nice couple, first-time home buyer, long-time rentals, first-time home buyers. So I don't think the current interest rate has changed the percentage. I think obviously
people need houses.
People need houses.
They need houses. They move out of their parents' house.
And so
graduate from college.
So the percentage of my business being first-time home buyers doesn't differ as the market changes. My overall number of loans or overall volume might go up or down. But I think first-time home buyers are still finding a way into the market and finding a way to make that home purchase.
So I promised when we did this podcast that I wouldn't get political, so I won't. But I actually had a first-time home buyers whose parents talked them out of buying a house because they thought the housing market was going to blow up, pop, whatever adjective you wanted to use it. How do you talk somebody off the fence like that? They're like, oh, yeah,
I think people have been saying that for 2-3 years.
At least.
It's having a lot of run up in value and equity position, but everybody has their own opinion.
I had a friend who we were playing golf, old high school friend, and he was telling me about how he was going to sell his house, and it was kind of towards the end of the pandemic, height of the market. He got great dollar for his house he grew up in. And he was just so sure that he was going to sell his house, wait 6 months to a year, and then buy it so low. And, he's nowhere. I don't know if I've got to check in with him, but he's probably still renting because there's no why they're waiting, why people are waiting. It just doesn't make any sense to me.
There's people talking the opposite side of the fence, just people trying to buy into programs that get ready. Now it's going to start to buy all these houses that are upside down and the bubble's going to pop and you're going to be able to get everything cheap again.
You say it long enough, eventually you'll be right. Broken clock's right twice a day.
Yeah.
But I think that, what do they say? It's, best time to buy a house was 10 years ago.
Yeah.
Next best time to buy a house today.
It's,
similar.
It's all supply and demand too. I mean, it's just a simple part of it. And as we spoke to earlier, the supply is still not there.
Right.
We've gotten better in our market here in Tucson. It's gotten better, but there's still not enough for the buyers in the market. So
I'm going to hit you a little hard, but I'm going to let Matt go first.
Okay. I just had a question on the first time home buyer for you, Ryan. What are you seeing in terms of gift letters, family help, that sort of thing? Has that changed with the values of homes and what people could afford to have families come in and help?
So a gift from a family member to help with down payment and or closing costs is a tremendous advantage for a first-time home buyer if they can do that. And if they can get that, I would say, much like I said with the ratio of my business, I don't think it's changed all that much. I still see it. I see it a lot with first-time home buyers, but I don't think it's spiked recently because of the increase in home values or it's spiked recently because of the increase in interest rates. I think it's just all been a natural part of the first-time home buying process for obviously a percentage of first-time home buyers. Some people don't have that and they have that ability. But it's a tremendous way to support, family members who are looking to buy a first-time home.
And do they have to be family members? Can anybody gift somebody?
Depending on the loan program, friends could even qualify.
Okay.
But there are different loan programs that have different qualifications.
And are co-signers a thing anymore?
Co-borrowers is a term we
borrowers.
use. But remember, a co-borrower
has to qualify.
has to be part of the qualification. And everybody, they're on the loan just like everybody else. And everybody on the loan, what I always say is we get to use their income. That's the plus. So that helps. That's the advantage. We have to use their credit score. Could be a plus, could be a minus. Right. And we have to include their debt.
Oh,
so sometimes a co-borrower can be a great thing. Sometimes a co-borrower who with a phenomenal credit score but a lot of their own debt won't be all that additive for you. And remember, we're always using everybody's credit score who's on the loan, and we're using the lowest middle score for everybody who's there. So just because I have a 650 credit score and I go out and get a co-borrower with an 800 credit score, we're still using my 650.
So that affects the rate that you're going to get or qualify.
So, but they're just guaranteed. That 850 just guaranteeing the loan.
No, the 850 is really not helping the loan at all because the whole loan will be looked at as a 650 credit score. What we're looking for in that situation is the 850 might also have a tremendous income that might help with what we call the lower the debt to income ratio and help the ability to qualify.
All right, I'm going to hit you with one, and if you don't want to answer it, then we'll make Matt answer it.
Okay.
It's whatever.
I can go to lunch if I don't like your question.
You can go to lunch if you don't like my question.
I'm going with you.
Yeah, great. So there's been a lot of refi promises out there.
Yeah.
Okay. In other words, hey, when the interest rates go down, buy, what is it? Date the rate, marry the house. Okay. Got to make sure I say that right. So people had a guarantee, listen, when the rates go down, you can do refi for us for free. Are those getting extended? And that's a sticky question, I know.
Well, he's asking that question because I exactly have that program or had that program. Refine your rate guarantee.
It's a drape.
Refine your rate guarantee where we would waive our origination fee on a refi through the end of 2025. That expired June 30th.
Yep.
Did not get extended. It had been extended, I believe, 2 times on a 6-month basis.
Did you get any refis out of it?
Well, it's still gone.
Oh, you did?
Yes, okay. We had a refi. A client we shared has refied and gotten that deal, that refine your rate, and we waived the origination. And I've had more than our shared client.
So in your program, they can still refi until 2025?
Yes. So we're still hoping, as we were talking earlier, we're still hoping for the rates to go down. And depending on when they bought, rates were higher than they were today.
Yeah.
So through the end of 2025, everybody who bought in the last, I can't remember exactly when we started it, but year and a half, at least maybe 2 years, they can get our origination fee waived on their refi through the end of 2025. I believe we might have some similar program or variation coming out again soon as well, is the kind of hint I got.
Got it.
But it's not currently available. So it was a great program. Obviously, rates haven't dropped as fast as we thought they were, but people are still have the potential to refi. What I typically tell people is if you can see a 0.5 point improvement on your interest rate, you should start to look at the refinance. Not necessarily automatically do it, but start to look at it. If you can see a point improvement, a 1% improvement, get it done.
Yeah.
Get it done. The only thing I would say is if rates are going to go down and they're going to, we're going to be on the downhill, you don't want to have to hit it 3 times on the downhill. So see where rates are going, see how fast they might be going down. I don't think that'll be a problem because I don't think, as we talked earlier, they're not going to go down very fast or as far as we had initially hoped. But you just don't want to end up refining and then 6 months later it's down even more and wishing you had or refining again kind of thing. So
we're up against the end here, but I wanted to ask one more question, and then we'll let you go do your lunch. So my question is it a smart move to refi every time interest rates go down? In other words, I grabbed a point. Oh, they went down again another point. It's only been a small amount of time. In other words, if things start falling quickly, is there a time period that somebody has to wait to refi?
There's not a time period somebody has to wait. Because there are closing costs associated with the refi, I don't want to see people do it too close together. We don't want to hit it too close together. We want to spread them out. But a full point interest rate improvement can definitely cover those costs. So that improvement can really see that cost covered. So
you'll go over the payoff time. What the costs were going in versus when they recoup that money.
Yeah, you look at when
improved payment.
Yeah, you look at when the savings on the monthly basis will help them recoup the principal that they added to the loan, because we're not making anybody pay this cost out of pocket typically on these refis. Typically people just finance that into the loan amount. So they're not coming out of pocket, but you're adding to the principal balance. And so we do the exact equation you're talking about. Hey, your monthly payments, here, we're dropping it by this much a month. It's costing you this much to do the refinance. You'll save that up again in
12 months, 24 months,
24 months. So the first time they do it, they know that number, and maybe we keep that in mind for them before they do refinance again. But I'm always happy to talk with people and look at it.
Well, that was my next statement, pretty much. I'm pretty sure, Ryan, that you would actually do a cost analysis on that and see if it was actually worth them to do it in any time and put those numbers in front of them, right?
That's why I tell them to look at it at half a point and do it at a point. We have a great program where I know, John, you and I closed the loan. You got 7%. My system tells me, hey, interest rates are about 6.25 now. John's at 7. Maybe you should give him a call and let's talk. And so I'm always watching that for my past clients who've already closed on their homes and going to reach out to them. I don't want them to feel like I'm churning and just trying to refi their loan left and right. I want to make sure we don't do it too often.
You want to give them the current information and give them their.
But I want them to know where the rates are and what they can take advantage of, and make sure they don't miss out on opportunities.
So it's almost time for us to close. I just want to make sure, Ryan, if somebody just wanted to get a hold of you and to have a conversation with you about their current loan or a future loan or a possible refi, what's the best way to get a hold of you?
Give me a call. My cell phone's on me all the time. I think you guys know I answer calls nights and weekends. My cell phone number is 520-609-4585. 520-609-4585. I do all my business on my cell phone. Happy to take your call anytime and help you work through a pre-qualification, come up with a plan for purchasing a home.
All right. Well, Ryan, we appreciate your time today. And like
Thank
I
you,
said,
Ryan.
I have done business with Ryan ever since I met him first. We've always had nice, smooth transactions. Matt and I both agree it would behoove somebody at least to have a conversation with them if they're even thinking about it. Matt, we got about a minute left, man. What do you want to leave these people with? Got anything?
I've said it all.
You've said it all.
Yep, for this week.
Oh, it's going to be a peaceful afternoon. So listen, my name is John Smith. I'm going to say goodbye for our first episode ever. We will follow you up with the second one. On behalf of Matt, myself, and Ryan, have a wonderful day.
Thank you for listening to today's episode of Real Estate Rumble. It's proudly produced and edited by Unestablished Media. If you're looking to start your own podcast or in need of social media services, design work, or even website creation, check out our website at unestablishedmedia.com. Thanks.